Hello, everyone, and welcome to our K-1 Pass-Through Entities series. I'm Dave Stauffacher, the Senior Credit Trainer with Lenders Online Training, where we work with lending and credit professionals to have them say yes to good loans. Linda Keith, our founder and our Chief Credit Training Officer, is joining me again today. Hi, Linda. How are you?
Hello, David. I'm doing well. How about you?
Just fine, thank you. You know, Linda, we've been doing this pass-through series for over the last few months, and which I've found very interesting. And we get so many questions from our viewers. And once again, someone just comes in with a great question that I wanted to pose our way. And that has to do, how do we handle partial ownership entities? That's kind of interesting. You know, when you think about this, we actually talked about this in one of our K-1 pass-through series, but you know, it's a common question that enters up that applies not only to our pass-through entities, our 1065 and 1120S, but it actually could come in handy with our 1121 C corporations as well, right, Linda?
That's right. So this is a question in our K-1 series, but actually 1120 owners can be partial owners. And there's even another one that I think I'm going to give you something brand new today to think about. So those of you who are all experienced and thinking I'm just getting a review, I like to throw out something you haven't thought of before, or maybe you haven't run into before. And that is multi-owner sole proprietorships. Let me say it again, multi-owner sole proprietorships, partial ownership of a sole proprietorship. How does that even happen? Well, it happens when you have married couples. So you can have what we call a split Schedule C, where let's say that my husband, Bill, and we run the company together. Typically, if you have a husband and wife working together in a company, they just pick one of the names to be the sole proprietor, and it shows up on the Schedule C. But there are times when the owners want it split. One example is if both owners want their Social Security tagging up in their account, whereas normally it would just be the one that's listed would get credit for that for Social Security, and the other one who might be working as many hours would not. So that's one example or one situation. Another situation, frankly, is if somebody comes in and they are going to borrow money and they're just qualifying on their own income, but they're the spouse that never got listed as the sole proprietor. How are you going to do that? So split Schedule C, that can happen. But what we're most often interested in and what was asked was, what about the partial ownership on these pass-throughs, or again, corporate? So we have two issues. One is you look at it differently if you're lending or analyzing the whole entity versus lending to the individual owner. So we'll take those one at a time. David, how about if they're lending to or analyzing the entire entity?
All right, let's look at from the entity's perspective. If we're lending directly to the partnership or the multi-member LLC, which is under the 1065 focus, the one thing about the 1065 is it doesn't list the partners that are involved. So we don't necessarily know from the tax return. So we're going to have to request to get all K1s to get a list of the owners as well as their percentage of ownership. So we're going to use the percentage of there. We're going to try to calculate that up to see who's all involved and what ownership status that they do, and decide from there, how do we want to treat maybe the guarantee perspective of it? Do we all want them to be limited guarantees based on the percentage ownership? Do we want them all to be fully guaranteed? So we'll want to make that decision from there. Now, if you go from to the 1120, now we're going to the S corporation. Once again, it does not list all the shareholders there. So once again, our process is that, but basically on your guidelines is we're going to get all K1s to list all the owners as well as their percentage of ownership. The one thing I want to draw attention on is the fact of the 1120E actually lists the compensation of officers. That's usually on the front page there on line 7. So it kind of gives you an idea what the compensation of officer is. And we can see that in the 1120E. Things we would look at as who the name of the individual is, the percentage of devoted time. That's something I want to touch in a minute, as well as the percentage of ownership, as well as compensation. So the point I want to make is it'll list the officers, but you can be an owner and not an officer. You can be an owner and spend a lot of time working in the business, but be a small owner. So trying to put together percentage of ownership as well as devoted is something of an interesting compensation as far as how much time I'm working and maybe how much control I might have of the checkbook. We just want to ask those type of questions. A couple of tips. When we're looking at just officers versus owners, the things that stand out is, okay, how much time, how much are they getting paid, and who is not getting paid a certain amount? And is that amount reasonable? Is it more than reasonable? Did they choose to take a high salary because the company is doing well? Maybe they took a lower salary one year. So it's trying to get some type of correlation or at least a thought process as to what do they own, how much do they work, as well as how much money they're taking out. Very important. Sometimes when I've done valuations for clients, if we've had some that don't put a lot of effort in the company because maybe they're on the latter stage of their career, but they're taking a lot of salary out there. Is that something that's going to be normal going forward? So that's something you'd want to consider. So the other thing when we're dealing with ownerships is who do you want to be involved with a guarantor? Most of us as lenders will consider the guarantor because of the closeness of the entity as well as who the decision-making power. If we're lending to that, we'd most likely want a guarantee. Now, granted, the guarantee decision making is based on your guidelines, but I know from past experience when I was in lending, I was probably requesting full guarantees on all the owners that were involved in the business because they had somewhat of a say-so at the table, and we wanted to make sure that they were there at the table for the journey of all that loan. So one consideration that we probably would need to consider here is when you're looking at this variation as to involvement in the business, compensation in the business, we'd almost, I guess I would prefer if we had multiple tax returns. If I was looking at one, I still have a lot of unknown questions as to how often they were involved in the business. Did that go up? Did that go down? What about their compensation? Did that coincide with maybe the company is doing well and they're taking a lot of money out? Fine, they did it through compensation. Or maybe they're not doing so well. What does that correlate into the compensation? So having multiple years is my preference. Sometimes we don't have that, but I think it's prudent when you're doing underwriting. So Linda, so we've had some variations with regards to a kind of a case study that we do in class. We just had that case study today. And I guess I'm kind of interested in your perspective on the global analysis and what it impacted in that case study.
Yeah, so this question of how we handle partial ownership entities, it's, we are threatening actually to do a t-shirt at Lenders Online Training that says, it depends. Check your guidelines, it depends. There's guidelines and then there's circumstances, right? And one of the things we work hard in Lenders Online Training is to get people beyond just what number do I put on a place in the worksheet to actually understanding the circumstances, the borrower, the loan request, and so forth. So in this comprehensive final case study, what we do in Lenders Online Training, after they've done the 22 modules on 1040s and advanced business returns, all 30 minutes or less, quizzes along the way to be sure they've got it, they've got to show that they can actually apply what they've been learning. So we have a final case studies. One is more focused on high net worth, high individuals, consumer or mortgage. Another one is general business. Another one is ag lending. So they kind of pick which one fits best. It's the ag lending one I'm thinking about. So this is a little spoiler alert. If you're about ready to take it, maybe you should just, mute me for a moment. But for the rest of you, exactly. For the rest of you, we put together a case study that's based on an actual farm loan. And then you've got a 1040. Those folks own an S-Corp farming operation. That's who we're lending to. If you just look at the S-Corp and you look at them combined, actually the S-Corp is strong all by itself. And then, guarantors, we look at that as a global, also very strong. However, they're a 50% owner of a third entity. Well, second entity, I guess. Now, it's third because they had a Schedule F also. So there you go. We got three things in play. The third one is not obligated on our loan. We're not lending to them. And we've seen banks that would say, well, if they're not obligated on the loan, we'll just get the K-1. We'll use their actual cash flow. We get a 3-year average. That'll be good enough. But that business is tanking It is tanking. And do you think a 50% owner might have guaranteed that business's debt? Yeah. Do you think a 50% owner might come to the table and try to save that business? Do you think, in fact, that borrower or that individual brought his best entity to us to get the loan because he knew we wouldn't lend on this other, yeah. So this is a good example where when they've done the analysis, and no matter what they tell us their guidelines are, because we always ask what their guidelines are, we have to come up with some so they can do the case study, right? But we'll find out if theirs is 50%, 25%. Does it matter whether they're obligated on the loan or not? But then we'll say, so help me understand, if they're not obligated, but you happen to know, you're a banker in the community that knows that entity is really in trouble, do you still just blindly follow your guidelines and ignore the problem? Do you just include it in your write-up, but not in your numbers? Or do you say, in this case, let's see what bringing that 50% of the deficit in will do to our analysis? Or if they've done that already, then what David and I will ask them in the review of the case study is, so do you really think that they only have to be ready to handle 50% of the problem? Do you know anything about that other 50% owner? Is that other 50% owner able to come to the table and cover their half of the problem? If you don't know, then how about if we take 100% of the problem against our global cash flow? If it still works, we can feel much more confident. I've still got a problem with that other entity, and what is it draining from us? But at least if we know that the one owner we know about could actually cover that problem and still this works, then maybe we'll be able to go forward with this. Maybe, though, I shouldn't even say maybe. If this is a maybe, then we have a problem. There needs to be a conversation, right, with this broker. You need to understand what's gone wrong with that entity. It's not unlikely that you also lend on that one, by the way. If you're an ag lender that does one of their farming operations, it's probably likely that you've got some kind of exposure to this other one. But so this would lead to a conversation. And I've got to say, if somebody is just following the guidelines, here's what we do with partial owners. If it's this percentage, we do that. If it's that percentage, we do that. If they're not obligated, we can ignore them completely. Yes, we need to help our junior folks understand the rules and guidelines. And we need to have them come to us. If you are the manager or a senior person, you need to get those junior people bringing these anomalies, these red flags, these things that don't seem like it would lead us to the best answer. They need to bring it to you. And you need to be able to take the bandwidth time at that point to see this on-the-job training opportunity to say, oh, you know what? Really good point. Here's our guideline, but here's when we might roll off that guideline a bit. Here's how I would see this one. Here's the additional documentation we'd want. This is the kind of write-up we need to have. This is the more frequent follow-up, or even given that we need to mitigate our risk a little bit more. So maybe we're going to require the higher end of our debt coverage ratio requirements, higher end of our liquidity requirements, stronger collateral, something that will recognize that there's a problem here, but we think we can work with this business anyway, and let's mitigate the risk while we understand the risk. And that means that we can't just fall back on hard and fast rules. We need to know them, and then we need to know when to come off them. I guess I'm saying buck the guidelines again, David, but I don't really mean, I don't mean to say that. I mean, understand the guidelines and understand when you should look a little bit to the edges and make sure. I mean, we want to make performing loans, support these businesses, make these loans that are consistent with our risk appetite, with our concentration risk issues, with our guidelines, with who we're trying to, what relationships we're trying to capture, because there's so much more to it. So we teach people the guidelines and the rules, but then we immediately start teaching them how to see around the edges and make different decisions. I think I kind of went off on a little tangent there, David. So let me see if there was something else I was supposed to say, because maybe, lending to the owner. Okay, I'll come back off the tangent. If you're lending the owners, though, again, what I just said is kind of true. What are your guidelines? Commonly 25% or less. We kind of go with the K-1 actual cash flow. Over 25%, maybe we do the full analysis of the entity and give them 25% of that, or just make sure that that at least supports what they're taking in their K-1. We will need the K-1 to determine percentage ownership because there's no place on the 1040 that would tell us that. And if you do have the K-1 and it says final, then for history, we would count it, but for projection, we would leave it out. And David, we may have covered this already. If we did, excuse me, but I said something in that 15 minutes. But again, if I've got a 40% owner, can I assume that they've only guaranteed 40% of the debt, or they've none or all? What are the assumptions there, or are there any?
I think it's interesting. I'm very probably conservative when I was in banking. If I was looking at a relationship, I'm going to ask each owner probably to guarantee it fully, regardless of their percentage of ownership. I wouldn't necessarily care. Now, that's from my perspective if I was negotiating. Now, granted, the owners can push back as to, I'm only a 30% owner here, so why do I have to deal with the whole thing? But once again, it's a conversation. Maybe it's somewhat of a negotiating position, but I'm going to have a conversation based on my guidelines with my team as to what we want to do if there is a pushback on a guarantor. Guarantors often have been more of a psychological ploy as to knowing that at the end of the day, if things don't work, we're going to try to see how much money we can get from the owners just to be able to deal with it. So I understand why we would want that. But back in the position as to, regardless of percentage of ownership, from a bank perspective, my perspective when I was underwriting, I'm still going to go for 100% guarantee. In our case studies, I would bring that with our loan officers to say, notice we asked for an analysis of 50% as a 50% owner as well as 100%. Why do you think we did that? And most were a little bit new to the concept as to, well, they only own half the other company. They're not even managing it. Well, we don't know that for sure unless we have a little bit of a track record. So once again, I guess we look at going back to the original question, which I thought was something that we covered as to in one of our K-1 series, to say, how do we handle partial ownership? And I think you and I had the conversation. Well, didn't we cover that in one of our talks? Well, we kind of did, but nowhere near the depth that we went here. We went off the rails, but all of it's relevant when we're dealing with partial ownerships.
And David, I need to go off the rails just a little bit more. Just a little bit more. We didn't even talk about passive versus non-passive just now.
Oh, no, we didn't.
I know, but here's where it's relevant. If it's a partnership, but they're on the passive side, they're likely limited partners. They have limited liability by design. Those guys are going to be very uninterested in guaranteeing your debt.
Correct.
Their structure is set that they are not. So you may have a much harder time getting limited partners, or if it's a limited liability company filing a 1065, but they are on the passive side. Once again, it's been designed so that those folks have limited liability. So I'm pretty sure that the place you can go after guarantors is likely those listed on the non-passive side on the 1040 Schedule E. They are active in the business. They're more likely to have guaranteed debt. They are more likely to have control over how the money's moving back and forth. So it may be that if your guideline says everybody has to guarantee, I would push back on that a little bit and say maybe not the limited partners. And then one more variation. I know it's 19.
It's good. I love it.
One more variation. And that is that, okay, can I remember the variation I was going to say? So one more variation is, do they have, you know what? I don't remember the other variation, David. We will cover this in a future live stream, no doubt. Yes. David, wrap it up.
Yes. So once again, as you can see how this goes, it's about conversations. That's what this K-1 and pass-through entity series is all about. conversations, not only conversations just between Linda and I, but conversations with you, your peers, your mentors, as you look at these relationships with your clients. And these are just common questions that come up when our job is to mitigate risk. Having conversations with our clients, having conversations with our underwriters as to how do we handle this? What is the risk? So I hope you enjoyed our K-1 pass-through series. We love to do it. Many of these questions come from you. So we thank you very, very much for being able to do that. You can actually share your questions by reaching out to us online at our Lenders Online Training. And you can look at the /, I believe it's a / of Ask the Experts. Please do that. And talk. That's another one when you want to find out more information with what we do here at Lenders Online Training to improve or enhance your professional skills as far as underwriting these. So many questions. And if you have a question and you'd rather just kind of ask us directly, please use our email and reach out at experts@lendersonlinetraining.com. And Linda and I will get back to you very, very quickly. Thanks for coming. Thanks for your questions and have a wonderful day.
See ya.